what we do to ensure that we have an instant payout in Ghana, what we need to first do is make sure that we have local currency sitting in Ghana.
When I look at this space, especially fintechs offering stablecoin payment services, it seems to me like barriers to enter are relatively low, right? A lot of it is OTC. And so I struggle to see what the long-term competitive advantage there is.
Regulation is a function of innovation, right? Because innovation happens and then there is regulation that says, okay, wow, it's going too fast and it's changing too much things. So we need to kind of structure it.
So the Collison brothers in their latest annual report said that stablecoins are superconductors for the financial services industry. There's been a lot of activity in the stablecoin space, from Stripe acquiring Bridge. MoonPay has been quite active on the acquisition front. And in Africa, we are seeing huge adoption. There's a recent report from Chain Analysis that showed that Nigeria alone did $60 billion last year of stablecoins. And so it's useful to see in such a massive growing industry where the real pockets of value are, understand the difference between hype and reality, and just get a good handle on the space. And for that, I want to speak to two very smart people. Eytan Messika is building Nilos. He's been very active on LinkedIn and as a company in kind of driving the stablecoin message. And also Nico. Nico is the CEO and part of the founding team of Nala. And their work has just been incredible. So I wanted to speak to these two people to just understand what's going on in the stablecoin space, what does the future hold, and what are some of the things that could actually lead to a decline in the industry. So today I've got the pleasure of being with two super smart guys, Eytan Messika and Nicolai Eddy. I met Eytan last year at the, I think, Africa FinTech Summit. And that was around Q3, Q4. And he was just thinking about now getting into this liquidity provider stablecoin business in Africa. In the period of like 6 months, he's been executing like crazy. And I think now he's gone to market with a product, and we'll talk more about that. So Eytan, welcome. And then I'm also with Nicolai, who's a COO and part of the founding team at Nala. I think recently Nala got into India, and before that they got into Philippines, two of the biggest remittance markets in the world, and they're just really executing at a global level. And they've been doing this for, I think, well over 4 years now, and they have a very deep understanding of moving money across the world, and particularly in Africa. So Nicolai, welcome.
Asante, thank you so much. It's great to be here.
Thanks.
And great to see you, Eytan.
Yeah, man. So the reason I wanted to have you two was, like I explained in the email, I just wanted someone who is stablecoins and someone who's been dealing with the problems of traditional fiat and just try and understand the space. And so I'll just have you guys do quick intros to yourselves, and then we'll get into the thick of things. So starting with you, Eytan.
Yeah, so pleasure to meet Nicolai. We actually, Teddy, I want to thank you because we meant to meet with Nicolai for a long time. But, we didn't have the chance yet to meet, so it's good. Yeah, so I'm Eytan. I'm the co-founder of Nilos. We started the company 4 years ago. We're basically building a liquidity network in exotic currencies. Everything is stablecoin based, working with probably the biggest payment companies in the world. Letting them accessing liquidity in Africa mostly, Latam, Southeast Asia, and also some part of MENA. And yeah, like you said, so when we started the company initially, we were mostly focusing on trying to build good on and off ramps, and then we expanded to exotic currencies about 6 months ago. And in the last 6 months, we launched about 15 markets. We closed about probably 50 clients from the remittance side to the merchants and fintech sites in emerging countries. So that's been one hell of a ride, but it's just the beginning. So happy to be here.
Good. Nico, I know I've done quite an intro, but it'd be useful to hear it from you.
Yeah, sure. So thanks so much for having us here. I'm glad that we get an opportunity to talk a little bit about stablecoins. I have maybe some non-traditional views on stablecoins as well. So hopefully we can get into a good discussion.
Yeah.
So I'm Nico. I am one of the 3 co-founders of Nala and Rafiki. So Nala is a cross-border consumer remittance product where individuals from the US, the UK, and 19 countries in Europe can send money into 11 markets in Africa and 4 markets in Asia. So India, Pakistan, Bangladesh, and the Philippines. And very soon we'll be launching a number of additional ones, looking at other geographies and continents as well. And the second part of the business, or it's a different business that we run, we call that business Rafiki, and that's payment infrastructure. So if you think about FX and payouts, that's what our big focus is. So allowing other businesses, so think of other remittance companies, they can plug into our single API and they can do FX as well as payouts. And so that side of the business is growing extremely quickly as well. And I'm excited to be here.
Super. Thank you for that. Now, we'll start with and I think it's very important to understand the foundational problem that stablecoins are solving. And so I think, Eytan, you've written quite a bit on LinkedIn. And so it'd be useful for you to tell us, what is the core problem that exists? What's not working right now? And what are stablecoins? And how do they specifically solve that problem?
Sure. So the main issue when we started the company, it was basically mostly around how money should move versus how it moves today. So if you're dealing with international payments today, actually money doesn't move. So the way it works is that you need to use a system of what we call correspondent banks. And the system is basically allowing banks to communicate with each other and let them actually kind of talk to each other to make sure that when you need to move funds from one country to the other, the money is pulled out from accounts that they own within each other. So if I'm in the US and I want to send funds in Nigeria, for instance, I have to own a correspondent banking relationship in Nigeria. It allows me to hold Naira. And then from there, when I trigger a payment from the dollar directly into Naira, I need to pull money out of this Naira account and let the payments be made there. The issue is that when you do that, basically today, you already know the problem that we have. So we have slow cross-border payments. It's very difficult to get access to dollars directly in emerging countries. It's extremely costly to be able to move those funds. Just because the underlying issue is that when you're a payment company or when you're a bank, holding those currencies that operate in volatile markets costs you money. Like the cost of having those relationships and maintaining those relationships is very problematic. Just first of all, because obviously it's highly inefficient. You need to move through the best banking relationships every time. So to route the payment through the best relationships. And when you don't have those relationships, it can take forever. So we've seen payments going into Africa or moving from Africa to other regions that can take up to 30 days, which is, when you think about payments, insane. And then this liquidity is not put at work, right? So when you hold and you hold relationship into those accounts, you cannot use them for other things. So you cannot leverage them for working capital. So it costs you a lot of money to basically having those money stayed put in those relationship accounts. And so what stablecoins allow from the beginning is, let's think about a world where you don't have to own accounts where you hold money directly and use those money to be able to make payout in the best way possible. But let's actually move the money in real time. So if I didn't have all the limitations that I have today, what would be the best experience to move money around? And the way I like to think about it is basically today we transfer money the way we ship cargoes, right? So you bundle a lot of them, you're waiting, and then, So basically it's a bit like shipping cargoes, like you bundle things, you're waiting to be able to transfer a lot of chunk of money to make sure that you capitalize on the fixed cost. And at the era of the internet, you should think about sending money like you send emails. So it should be instant, fast. You can do it in part bit, basically. If you want to send $1, you could do it. So this is what stablecoin allows you. So stablecoins are just the natural, like money natural selection, the way it evolves. If you think about dollars, it's tokenized gold, and stablecoin, it's tokenized dollars. So you always evolve to the cheaper and fastest way to move money around. And when you think about a store of value or a mini of exchange, which is the functions of money. And so stablecoin is just a cryptocurrency that is pegged to a more stable currency. most widely used stablecoins are pegged to the dollar, obviously. So Circle, Tether are the most non-issuer. When you think about one-to-one backed stablecoins, and there are other type of stablecoins that we don't mostly use when we talk about cross-border payments today. But that's mostly it.
And just to dive into that, it seems like what you're saying is that the thing that makes it move like an email is that there's a global ledger system that allows people to be able to say that money has moved from point A to point B, right? And therefore, it's like essentially buying, at the most rudimentary level, buying a digital store of value that can move easily from one place to another, vis-a-vis traditionally having bank accounts and having different relationships so that you can be able to move money from point A to point B. And what you're saying,
absolutely,
in the traditional system is that money sits in one place. What is happening is that instructions are moving, but you're not in control over whether those instructions are going to be effected. And there's so many things that can kind of delay the movement of money or the movement of those instructions.
Yeah, one thing that you're mentioning is basically I don't have to rely on the banking system to move funds using stablecoins today. So you can own your own virtual wallet and decide to instruct. And the instruction layer and the settlement layer is the same. So if you think about Swift, it's a messaging system, but then the money needs to move in another way. Today, when you instruct the payment on the blockchain itself, which runs like the stablecoins run on this technology, you instruct and the payment happens on the same level, which is the way it should be, right? Like the way we send emails.
And so that leads to you, Nico, because you're, first of all, you move money around the world, right? And before we can now understand how stablecoins may apply in your industry, could you just give us at a very basic level? Say you're moving money from someone who works in London and is moving $200 to Ghana, right? What is like the underlying money movement, especially as it relates to the correspondent banking system?
Sure. So the payment flow is relatively straightforward.
Yep.
What we do to ensure that we have an instant payout in Ghana, what we need to first do is make sure that we have local currency sitting in Ghana. So that's Ghanaian cedis, let's say. Mm-hmm. So we need to make sure that that's sitting there and it's available. Mm-hmm. Now, what happens is when a user logs into our application and let's say they use their debit card to make a transaction, once we get the authorization request from the payment gateway that says, hey, there's enough sufficient balance within the customer's actual bank account, then what we will do is we'll trigger that payout immediately in Ghana. Mm-hmm. And so it becomes a domestic payment. So it's a domestic local transfer from, a float account that's sitting in Ghana directly into the user's wallet. Mm-hmm. And the same thing applies in Nigeria. Same thing applies in Kenya. Same thing applies in Pakistan and India. All these markets are the same. Yep. Now, the thing to think about is the card settlement or the funds that we actually receive from our customers, we don't receive that until the next day. Yep. So T+1. Yep. And that's the next business day. So if the transaction happens on Friday, now we're waiting until Monday for that payment to actually, hit our account. So what that requires is that we need to have sufficient float, our own working capital, to make sure that we make these payments instant. And, what happens a lot of times in the payments world is, you have a lot of inefficient treasury systems and flows. And so as your business grows, your working capital needs and your float needs grow as well. And you can become very quickly a victim of your own success if you don't really stay on top of your growth and stay on top of how you manage your liquidity. So that's the way that the payment works in the traditional fiat world. The vast majority of our transactions go through that same payment method. Mm-hmm. And I think there's a few reasons why we can get into that. I think just in general, I'm bullish long-term on stablecoin. I think that there's quite a few, there's definitely friction to adoption. Mm-hmm. There's of course friction to fiat rails as well. And I think some of that friction is there, on purpose mm-hmm. to be able to, ensure that there's strong standards that are put in place. So we can get into that stuff as well.
We'll get into that. But I think you've raised two fundamental questions fundamental issues. The first is that in the existing system, you have to hold float, right? And so you'll have to hold Ghanaian cedis, you'll have to hold Kenyan shillings, you'll have to hold naira, you'll have to hold, all those currencies. And of course that comes at a cost. You first of all, like, you just don't have money sitting around to be holding billions of dollars of foreign currencies in other markets. And the second thing is that there is a settlement delay. So my understanding is that someone pays, someone swipes their card on a Friday, you get the money on the Monday, right? And then ideally, as you aggregate that money, you move it to Ghana so that you now have Ghanaian cedis to support the next batch of payments, right? And so there's both the cost of the liquidity, and especially in Africa, there's now the cost of the exchange rate, right? It could move against you theoretically over the weekend, and then you lose money. And so theoretically, stablecoins solve that. Like, you can now move things easily. But this actually now leads to the next, what you wanted to say about some of the friction. Because just from a very basic perspective, I should be shifting my entire business into stablecoins now that, both this liquidity and the Forex issue is solved. But I'm not seeing that, at least from the discussions I'm having, I'm not seeing entire businesses at least shifting all their liquidity settlements into stablecoins. And so why is that? What's causing that to be the situation?
I would say for me, where stablecoins can solve the gap today is it can solve the gap from when the payment is initiated, let's say in our bank account in the UK or the US, to when it's received in a local market, and when we get access then to the dollars in those markets. For me, that's not actually a big issue. I can make a payment same day, via SWIFT and receive the money in Nigeria and get credited.
Yeah.
And so, in a lot of times, like, these payment delays really happen when money leaves the continent. So when it's leaving emerging markets, you tend to find big delays. And that happens for a few reasons. It happens actually on purpose in many instances, because, if you're looking at a dollar rail, if a transaction is happening, let's say between a Nigerian importer and an exporter in Singapore, the dollars first go to New York and they're cleared through your Citibank or your JP Morgan, and there's a bit of friction there, and that's intentional because you have your compliance teams, in Citi and JP Morgan that are screening the transactions to ensure that it's a legit transaction, that all paperwork there exists. Now, there are some positives and there's downsides. A lot of times there's total misunderstanding of how the payments work and what the flows are, and that's why things can get sort of caught up and all right. So I was talking about some of the frictions, and there's some intentional friction that exists around screening. Banks need to make sure that payments that are being processed are being processed for a reason. A lot of times as well, there are there are large dollar shortages in a lot of these markets. There could be, for example, government intervention. Let's say the Central Bank of Nigeria has debt that they need to repay. They may be giving a mandate to the banks locally saying, before these dollars are given to the importers locally, make sure that these are going back to the central bank so that we can do our debt repayments. Yeah. And so there's all of these, intentional frictions that are definitely at play. Now, the experience for an importer in a business obviously is not great. But there's a bit of rationale and reason behind. I think it's important for us to call those out.
Yep. And would it be wrong if it was to say that for your business specifically, you're mostly moving money down into the continent, into some of these other countries, whereas for an importer, you're actually moving money out, and you're saying that there's no problem moving money from London to Nairobi. You get the money same day. In fact, I've done a payment before where I send the money in the morning, in the afternoon it was in my account. I had the SWIFT, and so this, waiting an extra couple of hours or even a day is not a big problem for your business. Is that what you're saying?
Yeah, I'd say that's accurate.
Yeah.
And, there's quite a few scenarios as well where we'll make a transaction with, let's say, a bank, Zenith Bank in Nigeria. All we need to do is show Zenith Bank the proof of payment, and on proof of payment, they'll credit us locally. And so, speed isn't a massive reason, or, for us to be able, it's not a massive issue is what I'm trying to say.
Yeah. And Eytan, do you see the same across the continent when you speak to some of these payment companies that need to do pay-ins into the continent?
Yeah, actually, we work with a bunch of remittance companies, and the two main reasons are not really because of the speed. It's more about the cutoffs and the limitation of the banking system. So we're working with like a Swiss remittance company, like one of the biggest ones. And what they say is that basically after 2 p.m. they cannot pre-fund any of their accounts. So you can send actually the money in 2:30, and the money will land like directly. So if you have a really good relationship with your local banks, you can actually get pre-funded. That's true. But if you want to top up your account after those cut-off limitations, it creates like huge frictions for smaller incumbents to enter the market.
Got it.
So what we found out is that stablecoins can actually help pre-fund those accounts after the cutoffs, and then we move the funds in real time and get the money directly into those local currencies. So we do have some interest for those remittance companies actually to move funds in. And the second reason is mostly like what I call a regulatory hack, which is what Nico mentioned about the demand from importers and from the merchant side in emerging countries to move money out of the country created a huge demand for stablecoins directly in those regions. And the demand in stablecoins in those regions created a premium for stablecoins going into the country. So there is like an incentive in price arbitrage to move money in stablecoin into the region. So we've seen remittance companies using stablecoin as a price arbitrage mechanism that gets basically better prices than if you use other traditional systems. If you compare like the USDC rate against Naira, the USD rate against Naira most of the time today, you can have like about 30 to 50 bips in arbitrage. And that was an incentive for new remittance companies to come in.
Got it.
So that's what we saw. But Nico is right. Most of the need actually is made from the south to the north.
Got it. Now, Eytan, could you just walk us through like what the different moving parts are, what the different elements of like the stablecoin ecosystem? So for instance, you've called yourself a liquidity provider. So what is needed to move, let's say, 100,000 USDT from Nigeria to Switzerland, for instance?
Yeah. So let's take it step by step. So the first thing, what you need is actually an infrastructure that allows you to receive, local currencies. So this is the first step to be able to move. So you need bank accounts. Like you cannot go around having local infrastructure on the fiat side. So you need to have actually a really good relationship and a really good infrastructure in local currencies if you want to help importers or anyone actually moving funds from there. This is the first step. Second step is having a good infrastructure on the blockchain side. So having the ability to receive money in stablecoins directly, hold those funds in stablecoin. And then in between those, you need actually good on and off ramp provider, what we call, so having the ability to exchange those local currencies into stables or stables into those local currencies. But in this case, what you need is what we call liquidity providers. So liquidity providers are people that are actually either make the market, so they have demand from one side and want to sell to the other, and they have liquidity in one currency and want to exchange it to the other. So you can build those relationships along the way directly, or you can directly build it with people that actually need to exchange money into another currency that might not be stablecoin. So for instance, with Nilos, we work a lot with merchants directly, or fintechs that need access to liquidity in USD, or merchant that needs to pay invoices in USD outside of Nigeria, for instance. So what we do is that those merchants, they use Nilos to pay those invoices, and what they do while they pay those invoices, that they fund us basically in Naira. So when we collect those Naira, we have actually Naira to sell to other companies like Nala or like any other remittance company that might need those exotic liquidity. And so the other part of the system is once you have banks, liquidity providers, and a wallet infrastructure, you need to replicate that in other regions to be able to do the full flow. So you collect Naira, exchange it to stables, send stables in the other part of the world, convert it back to dollars, and then settle through the local rails again. So effectively, just the system is just connecting local rails together with the intermediary level layer, which is the stablecoin one. So that's how it works. That's the full stablecoin sandwich model, the way we call it. And then you have part of it. The example you gave is just exchanges USDT to USD or to Naira. You just use one leg of the system. But today, for user experience and making sure that people don't have to wait to change the way they currently work, we mostly use the full flow, which is give us any currency, we give you the other type of currencies, and we handle our liquidity in stablecoins just because it's easier to move in and out of those currencies using our infrastructure.
And so right now, it sounds like Nilos is offering the entire suite of products. You're accepting local fiat, and then making payments into local fiat on the other side, be it USA, whatever. So you're offering the full stack of payments. And there's some people who, for instance, in Nigeria, will only accept local currency and then work with a partner for, let's say, the conversion into stablecoin. Is there any specific reason why you set up like that?
Yeah, so the reason is that if you want to be competitive in those regions, price is like probably the biggest driver to create good relationship, at least if you want to work with companies on the remittance side, so doing north to south. Like what we've seen is we've talked with probably all the players in the market, and they all kind of need better rates, right? Everyone is selling better rates.
Yeah.
So the reason we set up like the infrastructure like that is that the most optimized way to get price down is to actually net funds. So to have the infrastructure that Nico described at the beginning, which is local currency in both ways. The reason is that since we mentioned at the beginning, there is like a lot of issues maintaining those relationships or having this liquidity in those accounts. So the reason why we offered this kind of product is to build a network effect while you serve on one side of the continent merchants getting access to USD, you pull out those exotic currencies that you can resell to remittance companies and create a network effect where all your clients become liquidity providers in the network.
Yeah.
So that's the reason why we offer both of those parts at the same time.
Yeah.
And to get prices in the most optimal way.
Yeah. And Nico, you mentioned earlier that you're long stable coins, but at the same time, you kind of gave a very sober outlook in terms of, how remittance companies look at the space and the key problems to be solved. I'd like to understand, why you're long stablecoins specifically, and you can break it down. So number one, specifically as a remittance provider, and number two, just someone who understands payments in the continent. Why you're long stablecoins?
Cool. Yeah, definitely. I want to add one more piece to, why there are barriers today that I think is super important to call out. And, that is, we have our strategy on Rafiki is to go deep into payment infrastructure. So that means payments inbound, payments outbound, and that also means getting licensed in each of these markets locally. And we think that is the long-term play because, to be in a market long-term, you need to be on good favor with the regulator. Now, if I go and tell the CBN, let's say, hey, I am, working with USDC provider to help, get liquidity. All they hear is crypto, and immediately they think it's bad, right? And so, and this is not just necessarily, the regulators. This is then the banks as well, because they know the regulators, know the banks sometimes deal with this. The banks don't want to have to deal with the headache with the regulators. And if I'm sitting in the regulators' shoes, I have no incentive as the governor of CBN to allow stablecoins to exist because one, it makes it very difficult for me to affect my monetary policy. How can I do some of the activities that I was talking about before? If I need to withdraw dollars from the economy, how can I make sure that I do that? Especially, if the dollars are not technically available for me to take from my banks that I regulate locally. And so, I think there's definitely there's those barriers that we have to be cognizant of. I think it's a bit tricky as well because, there are a lot of importers who are very dollar strapped in markets across the continent. And this has an impact, of course, on prices locally. This drives inflation long term because of supply and demand, restrictions. But if I'm looking also at local regulation, let's take Nigeria, for example. If I'm an importer, I need to submit a Form M to the bank to be able to do my imports. And in this Form M, I have to register this with a local bank. and that local bank is required to do official, transactions at the official rate.
Yeah.
And so, while crypto definitely solves the immediate need, it sits sort of in that gray zone, which, if you're playing long-term games, which is what we're trying to do, it just makes our business way more challenging for maybe some short-term arbitrage. Why am I, bullish? I guess changing, notes here. Why would I be bullish long term? Well, I think, long term, if we can get and find a way, for example, for the M-Pesas of the world in Kenya, for the Airtel monies of the world, the Pesa links and the bank cooperation to accept stablecoin and come up with a framework that, is adopted and accepted.
Yeah. That
makes my life very easy. And, to Eytan's point, I don't need to do as much, pre-funding in local currency. I could potentially have the M-Pesa of the world being that liquidity or that exchange between local currency and CC, and that means, less of a debt facility that I need.
Yeah.
So long term, it definitely solves problems. It solves issues. I just think that there's of course the short term boom that you can get, but I think it's going to take some time for regulators to framework and think about how they adopt it. And then I think once that happens, then it's a no-brainer. Obviously, USDC, USDT is.
And you brought up two issues that.
Can I counter that theory?
Yeah.
because now you had me. There is one point that I want to mention, which is important, is that most of the fintechs innovation, right? They especially in the last 10 years, they lied in the gray zone. So if you think about the incentive of accepting Bitcoin as a reserve in the US 10 years ago, there was absolutely no incentive. And so everyone called out and said, this Bitcoin shit is going to get really regulated. It doesn't make sense. And what happened is just that the user experience drives the regulation. At the core, that's what we see. Is that the user experience is so much better now for those gray zone applications, that what Nico said, that it drives a use case that creates much bigger incentives for regulators to look at this and say, instead of cutting it completely, we're just going to find a way to regulate it in a good way. And once the regulation comes, trust come with it. And then when trust comes, banks come with it, and all the applications come with it. So what we see now is something that can seem uncontrollable from the central bank perspective. But I'm sure that there is today virtually no reason for the central bank to say we're going to stop it just because they cannot today. It's impossible to track. It's really impossible to track the way those new payment systems are being built. On the other side, what Nico said, which is really important, is that you need to be in good favor of the central banks in all those regions. In Africa, you can, if you're not doing things in the right way, you can absolutely get shut down by the central bank at any point, any time. So you absolutely need to talk with the regulators. And when you kind of start getting some actually really good traction, you're going to face those challenges. But there is a loophole, and I want you to make sure that it's heard, because that's important. I completely agree on the funding layer. It's going to take time. But I think in the meantime, people are still going to use those systems in the gray zone to actually solve their problems. It's really, really hard for those people.
Yeah, and if you look at especially a market in Nigeria where you're seeing so much adoption, it's effectively a man-made problem, because the central bank has stuck to a controlled exchange rate, which is not clear with demand and supply. And so you kind of have to, a businessman is not going to say, I'm not going to do business because we have a dual exchange rate. So you'll find a way. But, you brought up the point of regulation. It's going to come down to it, but I think it's useful to have a discussion now. My view on regulation, and I want to hear yours as well, is that the entire crypto stablecoin space in Africa is calling for regulation, but there's a lack of clarity. It's almost as if, any regulation is good. But if I was a smart regulator, I'd put regulation that actually hampers the industry. So for instance, one of the things I see is that there's this virtual asset service provider where crypto is being licensed as an asset, right? And if you license something as an asset, then all of a sudden now you can bring taxes on each transaction. So like if you do a transfer of stablecoin, there's this digital asset tax and you do 3% or 4%, and that will just kill the industry, right? And so if you were the regulator, if you had an ear to the regulator and you said, actually, I'm looking to do this, what would you advise in terms of how to go about regulation? And maybe we can start with you, Nico, and then we go to Eytan.
I think it starts first with really understanding like the foundations and the fundamentals of why do these cryptocurrencies exist? Why do stablecoins exist in the first place? And making sure that there's a really deep understanding of like the applications. And in order to do that, the only way to do that is if you're really engaging the private sector and you're engaging, companies like Nilos, like what Eytan is running, like companies like ours. Come around and have a roundtable discussion to talk more about it. I think that's the important piece, is really understanding it. I want to give a small shout out to the Central Bank of Rwanda that does a very, very good job at this. Exactly, they really engage the private sector in a very meaningful way. So I think it starts there. And I think it's going to be crafted, like the reality is what Eytan said is, if the regulators like it or not, it's going to exist and it's going to continue to grow, especially if it's solving big needs of individuals and businesses in these countries. And so it's got to be something that happens, jointly together with, the private sector in terms of what that looks like. I'm over to you, Eytan, to see if you have any specific ideas, but I think this warrants like a deeper, I got to think more about that, to be honest.
Yeah. Not actually. That's probably one of the most important ones that you mentioned. Like, I really like regulation is always a complicated topic, because the way I see it is that regulation is a function of innovation, right? Because innovation happens, and then there is regulation that says, okay, wow, it's going too fast and it's changing too much things, so we need to kind of structure it. And then once regulation happens, there is basically innovation that comes after it, because they frame the way innovation can actually continue. So innovation is also a function of regulation. So you have like an equivalence mathematically that says innovation equals regulation. So you need to talk with the one that innovates to be able to regulate properly. So that's the point of Nico, which is basically making sure that the private sector and the public sector are talking to each other. But probably on the more, let's say, technical level on the stablecoin side, there is a bunch of things you can think about when you're a regulator that could make sense regarding stablecoin, which is one, what would be if we consider stablecoins as another currency, let's say, what would be the approach if we were like holding another type of currency in our economy, and think like on the basis layer of the traditional FX system. That's how I would approach things. I would say, okay, I need to have like reserve requirements. I need to make sure that a lot of people have the same level of compliance and KYC levels that what they would have on the fiat system, and kind of matching the same thinking pattern that they have on the fiat side, kind of corresponding it to the crypto side and to the stablecoin side, and then making sure that the differences there are in the infrastructure, especially on the crypto side, you have different differences, make the gap match. So I think that's how we approach it. And the only way to do that is, again, matching to the first point, which is talking to the one that are building. And that's how you build the best moats and the best companies is when regulators speak to private companies, you build really good innovation systems.
Yeah. And I think you raise a valid point, but I think what you're saying fundamentally is that if you're to regulate stablecoins, especially as a central bank, you regulate them like you currently regulate dollars, right? You enforce reserve requirements. You enforce that banks report their dollar positions. They send their blotters to you on a daily basis, and then if an importer is doing a transfer and they fill their import declaration form, so long as they tick that, as long as whether using stablecoins or not, just do the normal process so that I as a central bank can have visibility. But I think when you pull on that thread long enough, you will come back to the same issue. So long as like the market has dual exchange rates, whether it's stable coins or not, you still kind of come back to the same problem. So it seems to me that it kind of has to, at least in a market like Nigeria and Francophone, it kind of has to exist outside of the central bank control to kind of get the adoption it's getting.
Yeah, but there is reasons why the regulation, right?
Yeah.
Like what we mentioned with Nicolai, it's macroeconomically.
Yeah.
But those countries are not dumb. Like they want to run to actually make sure that their currencies is not doing what the currency did in Venezuela or in Argentina and somewhere. Like they hold regulation rules and requirements actually for a strong reason, which makes sense. It's just that I think what I said, you need to think about how they regulate dollar to kind of apply some of the rules. The experience is not the same. So it can solve part of the issues, but the thinking pattern is the same.
Yeah.
Which you're gonna come to new rules basically, because at the end, crypto is not like fiat. You have wallets which are independent from the banking system. You don't have the you cannot apply credit risk to wallets. You apply what we call know your transactions, not know your wallet, not know your identities, or know your customers. So there are going to be differences which are going to solve part of the problems, but at the end, those regulations exist for a reason, which are actually making the economy stabilize. So so I'm not sure it's still very.
Nico.
Yeah, it's a very good point. Maybe I'd add. Today stablecoins provide two things. It provides more potentially liquidity at a parallel market rate, which is beneficial, and then it also solves all these speed issues that we talked about. Long term, it really should only be solving that speed issue. Because the parallel market piece is governments have no incentive to allow that to exist because for all the points that we raised previously. So. I think that what we will likely see is something exactly what Eytan said is have some type of reserve requirement. Maybe there's some type of settlement framework as well, where it needs to settle through a government infrastructure layer where there's greater visibility, and they need to have some level of control around stablecoins. Otherwise, it will really face challenges for mass adoption across these local markets. The only way to solve the parallel market and the inflation is by increasing your exports, or decreasing your imports. And that's still the fundamental issue. And I'm super passionate about that piece. But that's parallel markets, and that will continue to exist unless that's solved at a level.
And you raised the government kind of settlement layer, and maybe the question to you, Eytan, is that does that mean that where does that sit with CBDCs? Because if you think about it, CBDCs are like government stable coins, right? Is that how now this kind of works within a regulated environment? That it's like all roads lead to CBDC.
That's a good question. To be completely honest, I'm not a big believer in CBDCs. I just, again, like most of the innovation comes from the private sector, and then it gets like thrown out to be able to be used as an old way of thinking. And so CBDCs for me are just like a way of saying the technology works, let's apply it to what we are currently doing. But the people are actually moving from the system because they actually want a better infrastructure and a better way of doing things. So CBDCs I'm not sure it's going to solve the problem entirely. And I'm just not, like, also probably the main part is that I wouldn't trust a central bank to kind of run an innovation program on the stablecoin side, just because it's going to take them forever to actually push them out. But so innovation needs to happen anyway before that.
But Nico, let's say there's a pound CBDC and there's a naira CBDC, and there's a global central bank program where these things are, you can settle them very quickly through some kind of shared infrastructure. And so when someone wants to make a payment to Nigeria using Nala, you just get their pound CBDC, quickly trade it for Naira CBDC, make your small margin. Would that be like an ideal world? And the only reason I'm raising this is that, Eytan, your points are valid, but a lot of payments go through this kind of bureaucratic infrastructure. Faster payments in the UK, UPI in India, PIX in Brazil. It's government type infrastructure, but it's actually leading to innovation. So Nico, would that work?
Yeah, I mean, there's the theoretical piece, which I think is what Eytan is saying. In theory, there's you diagram this whole thing out, and it's like brainer, it can happen. But then there's a lot of nuance.
Yeah.
Ensuring that it's actually executed upon, and a lot of you need to ensure that the CBDCs interface well on a local currency perspective to the stablecoin that's being used. Yeah. So there's a lot of nuance to ensuring that it actually gets live.
Got it. I think Nico, you're in the middle of a train of thought. Would you want to complete that? Or should we just jump? Let's jump to the next one then. I think two last things. The first is around use case. Of course, there's the import use case, which is growing quite significantly in the continent, especially West Africa, Nigeria. I think in East Africa it's there, but it's sporadic. It's like up and down. Because the dollars are, the banks are doing a decent job. Eytan, where do you see a lot of these use cases coming from?
So on our side, we've seen mostly 4 different use cases from the application. So there is remittance payment companies accessing exotic liquidity without pre-funding. We mentioned that. Importers moving money out, paying suppliers directly using stablecoin side. And then there's 2 more, which are very interesting. You have treasury rebalancing between subsidiaries. So we've seen companies in Nigeria moving funds to Dubai without having to go directly to dollars because they have holdings directly in Dubai. So we've seen a lot of those intercompany kind of movements directly on the app. And then there was another one, which is hedging against inflation for local workers directly in those regions. So Argentinians that get paid by companies outside that wants to hold funds not in Argentinian pesos but in dollars can actually hold stables directly and then move the money in and out from pesos to dollars. So we've seen probably those 4 different use cases, and there is a 5th one, which is yield generation. So that comes after.
Got it. And I think, Nico, there's a question around, it makes a lot of sense to focus on, this long-term viability. As a financial services company, your reputation with the regulator is the biggest thing. But one could argue that you could have a stablecoin native remittance company come and due to the efficiency of the whole ecosystem, they're able to offer better rates. Do you think of that as a company in terms of, if we don't move fast, someone could actually come and say, we don't care about the regulators and we'll just go for the market and offer way better rates than, not way better, but better rates than you?
I think it's a good question because, we get quotes every single day in the Naira market, probably 30 quotes from 30 providers, be it from the banks, be it from the local FX brokers, be it from the crypto folk. And what we see is there's not actually a massive difference between where the parallel market trades on fiat and where the parallel market trades on crypto. So we see a lot of remittance companies that do trade at the parallel market. The regulators tend to, in a lot of these jurisdictions, they tend to acknowledge that. They know that it's happening. But what they really care about, I know CBN, for example, they really care that the dollars hit the country, that they land in Nigeria, even if there's that parallel trade that does take place. And so I think that's the thing that I would note. Many of the remittance companies that are out there, they are trading at the parallel market on fiat. And I wouldn't say that somebody who's just purely crypto native will have that much of a competitive advantage in terms of rates, at least in terms of what we're seeing.
Got it. And for the broader ecosystem, and I think this goes both to you, and it's more of like a forward-looking question. It's still a very nascent space. You've got liquidity providers who are making money on FX and a transaction fee. You've got fintechs in Nigeria, for instance, that just focus on the local fiat part and, enabling payments using other partners. Like, what is, especially for the import use case with you, Eytan, what is like the right, who has a right to win? Like, which companies are going to win, right? Does it make more sense for me to, set up a neobank and offer stablecoins as a service? Or because when I look at this space, especially fintechs offering stablecoin payment services, it seems to me like barriers to enter are relatively low, right? You're making FX and the transaction fee. A lot of it is OTC, right? There's all this fintech, but at the end of the day, a lot of transaction is OTC. It's like, exchanging emails and all that kind of stuff. And so I struggle to see what the long-term competitive advantage there is. Like, which elements of the stack are actually going to be long-term sustainable companies?
Yeah. I can think of like 5 different things right now. So the most important one is going to be probably the regulatory side. So I think that's what Nico said at the beginning. That if you want to be long-term in having like a moat and probably like an advantage, a comparative advantage on the long run, you need licenses in the region if you want to be serious about any country you're operating in. So any of those stablecoin providers that are working under light licensing and are not considering getting licensed at the end are probably going to get directly out of a trust and reputation side.
Yeah.
So if you think about like a big company, they want to work with a company that's going to be licensed once the framework is live, right?
Yeah.
So that's probably one. The second is really good access to banking relationships on multiple levels. So you cannot own only one banking relationship, you need to own massive ones. Because if you want the experience to be instant in Africa, especially, you need to do the same bank transfers kind of infrastructure. So you need to have access to all those banking relationships, making sure that if one is stopping to work with you for any other reason, you can actually have redundancies on that side. So that's also like a big part of the work when you build the moats. It's all those relationships that you build, a network that you build on the banking side. And then once you have that, you have 3 other things, which is, I think the one that are going to win on that side is the one that are specializing on one specific corridor and own that corridors to build the first 2 ones. So I've seen a lot of different companies saying we have global coverage from day one, and those guys are not serious about like having the proper infrastructure to manage all of those currencies. You need to make sure to build specialized infrastructure, banking relationships, liquidity providers, and all the things that I've mentioned, licensing, to be able to own one specific corridor. And then about what you mentioned, the directly having OTCs manual. I think AI now is giving you a way to automate stuff on the back end that looks automated on the user experience. So what we built, I can give you an example of what we built at Nilos, but we have a way today in Nigeria, for instance, to source the rate from the P2P market directly, have a script that runs 24/7 that can quote directly from all of our providers. You can run also chatbots that answers the clients. And then once we get those different quotes on both sides, we can split and affect a rate that can get validated by the clients afterwards. But that looks that the experience is completely automated. And using AI agents, you can kind of trade automatically with the liquidity providers you have. So I think like the tech part of the solution using AI is going to be like a huge competitive advantage for those markets where it's very fragmented today. So that's going to be probably the fifth part.
And just on that, I could argue if I'm a big company, I have, there are 4 of you that are offering these payments. 2 years from now, you all have relatively good infrastructure on the, let's say, Nigeria-China corridor. It seems to me like a race to the bottom because, you're all going to be pushing hard to quote me the best rates. Would you agree? Does it? You're nodding your head very seriously.
There is 100 payments company that are probably doing 100 million revenue today.
Okay.
Like if you take all of the payments company.
Yeah.
It's not I don't think it's a game where there is only one company that is going to get out of it. Yeah. So it's just like a restructuring of the market around this technology.
Yeah.
And I think there's probably going to be a lot of different providers that are going to be billions companies. So I'm not worried about that at all.
Okay. And Nico, two things for you before we wind down. Number one, you said you have some non-traditional views on stablecoins. I'd really love to hear those. And number two, do you have a view on like where the winners will come out? And it's a massive market, as Eytan has said, but where like the real sustainable pockets of value come in from in the stablecoin ecosystem.
Yeah. So I'll be brief on these ones. I think the non-traditional being, in today's world, everybody's just gotten so much hype around stables. They think that, and a lot of people who don't really understand the payments world, are the ones who probably are disproportionately excited about it. There's nothing really new that's happened besides the US having a more favorable stance and banks in the US having a bit more favorable stance on working with crypto and payments businesses. So I would say non-traditional in that, many people ask me, oh, what are you doing about stables? What are you doing about stables today? Things are changing so fast. And I'd say, yes, things are changing fast, but I wouldn't say faster than they were changing, 12 months ago. In terms of the players that I think will win, I think there will be these businesses, and the way that innovation happens and the way that Eytan described this, you'll have businesses that will sort of knock down the doors and plow the way forward. And I think those will be a lot of the businesses that are the crypto native businesses that will do a lot of like knocking down of doors. And then the train that follows behind that is the traditional businesses, the traditional payment companies, the Stripes of the world, the Checkouts of the world, the currency clouds, all of these infrastructure businesses that will start to have a play as well, but it won't be solely, the crypto side of things. And I think, regulators will adopt, they'll be, they'll have to reckon with these changes that will happen. And, it's really thanks to the innovative businesses that are the ones who are kind of plowing the way forwards, making room for other businesses to grow. So I would say, I don't see, just a crypto native business suddenly taking all of the lunch away from, the Stripes of the world. Because you can see Stripe is already adopting and changing the way that they operate.
Yeah. No, that makes a lot of sense, and it's kind of a view I've heard in that as the technology emerges and once things become clear, some of the more traditional companies who have the operational chops around fraud, payments, managing treasury, as well as good customer relationships will do well. And it's we have to wind down now. It's been an amazing show. If we could actually go on for another hour or two. It's been an amazing show, amazing discussion. Both founders, both executives have very clear views on the market. We're super insightful into the space. And the key thing is that indeed, in the long term, stablecoins have a massive role to play in modern financial services. But regulation is going to play a key role in making sure that that they are sustainable in the long term. And thank you so much for joining the show. Make sure to subscribe to the F Squared podcast. Make sure to subscribe to the newsletter, and our socials are below. And let's continue the conversation. Thank you.